To Roth or not to Roth? Roth conversions are one of the most talked about strategies when it comes to retirement planning, but it's also one of the most misunderstood. Here's 7 tips to help you decide. Hello and welcome to SWBC's Uncharted Wealth podcast, where we help you navigate the financial complexities of retirement and help you retire with confidence and clarity. My name is Mike Walters. I am a certified financial planner and a wealth advisor here at SWBC. Today we are going to talk whether to Roth or not Roth. Okay, I'm going to give you 7 key things to help you decide whether you should be doing Roth conversions or not. And this is especially going to be important if you are within 10 years of retirement. Okay, we'll talk about taxes, we'll talk about Medicare premiums, Social Security, all of the above, and basically how to keep you from allowing the tax tail to wag the dog. We don't want that to happen. So grab your notebooks, grab your pencils, and let's go. All right, the first one of these is managing your RMDs. Mike, what does RMD mean? Thanks for asking. Required minimum distributions, okay? This is when you have to take money out of your pre-tax accounts. Okay, your IRAs, your 401ks, any money that you have been setting aside in these qualified accounts that you have never paid tax on, the IRS is going to make you take money out when you become a certain age. Okay, right now it's age 73. In 2030, it's supposed to change to 75, right? So if you're not age 73 before or by 2030, the RMD age will be 75. But for today's purposes, we're going to say it's age 73. Now, these RMDs can create these large tax spikes later in life. Why? Because anytime you take money out of a pre-tax account, it is taxed just like ordinary income, just like you were receiving a paycheck while you were working, okay? Doing Roth conversions now can help to potentially eliminate or reduce your RMDs later on. Why? Because one, Roth IRAs, the money in there grows tax-free because you paid the taxes up on the front end. Number 2 is because Roth IRAs do not have required and minimum distributions. So if you're one of those people that, hey, I make enough money from Social Security or I have a pension and I don't need to take money out of my portfolio, Roth IRA is going to be where to go because you can literally let it grow for as long as you want, and when you pass away, your beneficiaries will receive those assets tax-free as well. Number 2, inheritance implications, okay? So a lot of people are thinking, well, I don't really want to look at Roth conversions yet in my lifetime, but if you are anticipating receiving some type of inheritance, from whoever, and it is in the form of pre-tax assets, so let's just, for example, say your mom or your dad has a huge IRA balance out there. If they pass away and they leave it to you, you have to take those RMDs from that account at some point, okay? So, we don't know what the tax rates are going to be in the future. We don't know what your income is going to be. We don't know all these different, variables when you actually receive the inheritance, again, because we don't know when mom or dad's going to pass away. So when you're receiving this inheritance and it's coming to you as, as an IRA, pre-tax money, well, now you're going to be set by these specific rules that the IRS sets, where you either have to take the money out over a 10-year time frame, or depending on when you receive it, when the person passed away, you might be able to get it to stretch longer than that. But either way, you're going to have to start taking distributions from those accounts, and it might push your tax brackets up higher. So doing Roth IRAs, again, it's going to offer tax-free growth, and it's going to be even more valuable if you are expecting to get an inheritance, especially under that 10-year rule. So, when you get that inheritance, by the way, you cannot convert those assets. You are getting it as an inherited asset. You have to distribute it. But if you are expecting that, maybe you convert your assets, okay? So the way to think about that is, if you feel like you're going to inherit a tax bomb, defuse your own bomb beforehand, okay? There's a little plug to one of my favorite IRA experts out there, Mr. Ed Slott, okay, but just throwing that out there. He coins that whole defuse the tax time bomb thing. But it's great stuff. But anyways, the third thing to consider is future tax rates. Now, my crystal ball is broken. I can't tell you what the tax rates are going to be in the future, but tax rates can change every couple of years, it seems, right? For example, the Tax Cuts and Jobs Act of 2017, when Trump first took office, lowered all of the tax brackets that we are currently in right now. Now, those policies were set to sunset in 2026. However, when Trump retook the office for 2025, they extended those, tax cuts permanently. Okay, I say permanently in quotations because it's written in pencil. Okay, the tax code is literally written in pencil. So even though it says the tax, rates are permanent, they can be changed later. All right, and we have no idea what they are going to be in the future. So if you think that by the things that are going on with our debt in this country, or policy changes, or whatever, if you think that there's going to be some type of increase in rates in the future, Roth conversions can be your hedge against that. Okay. Number 4, and actually before I get into that, let me just stare at the camera for a little bit, and I think you know why. For those that you don't know what I'm doing, it's because I'm waiting for you to subscribe to this channel. All right, did you subscribe? What about now? What about now? Okay, anyways, like, comment, and subscribe because we want to make sure that this information is getting out there to everybody. So, appreciate you if you did subscribe. Thanks again. I hate talking to myself. Number 4, IRMAA penalties and Medicare planning. IRMAA, I-R-M-A-A, stands for Income Related Monthly Adjustment Amount. Okay, if you've never heard of it, it's basically a penalty for making too much money. Okay, and they assess that penalty on your Medicare premiums. Okay, so if you didn't know that everybody does not pay the same Medicare premiums, now you do. Okay, they base that premium on what your income is when you become Medicare age, when you get age 65. These surcharges are based on what your income is on any given tax year. So for example, if you're getting Social Security income, you have a pension, you have some portfolio income coming in, that is going to determine what your Medicare Part B and Part D premiums are in future years. So if you're making more money, you have to pay more in Medicare premiums. So again, if you think that your income is going to start stacking on top of each other later on in retirement, and it might make sense to do Roth conversions earlier to potentially avoid these IRMAA surcharges. However, big however here is if you are already Medicare age, well actually I should say age 63, because Medicare actually looks back 2 years prior. Okay, so the IRMAA surcharge is based on your tax return when you're age 63, even though you don't technically get it until age 65. If you are looking at doing Roth conversions around age 63, you need to be aware that doing Roth conversions, again, is going to increase your income. It could potentially increase your IRMAA surcharges for Medicare. Number 5 is eliminating taxes on Social Security benefits. Now, again, a lot of people tell me that they did not know that Social Security benefits were taxable or not taxable, okay? It's different for everybody depending on what their income is, okay? Currently, as it sits, your Social Security benefits can be taxed anywhere between 0, nothing, to 85%, okay? Depending on what other income you have coming in. So just like I said earlier, if you have a pension, you have portfolio income, you're doing Roth conversions while you're taking Social Security, this can affect how much of your Social Security benefit can be taxed. So these Social Security taxation thresholds, they have not changed for over 30 years, which is a big reason why more retirees are paying taxes on their Social Security than ever before, right now. So if you feel like you're somebody that wants to either reduce or eliminate taxation of your Social Security benefits later on, then looking at doing Roth conversions to, again, avoid distributions from those pre-tax accounts can help you mitigate that later on in life. All right, now with 5 down and 2 to go, the last ones that I'm going to talk about have to do with managing your tax brackets. Okay, number 6 is going to be what I call advanced marginal tax bracket management. Okay, and it's a fairly simple thing to kind of think about, but when you're in retirement and let's say you've been working with an advisor and you've been tax planning effectively, a lot of people will get used to being in these lower tax brackets, right? So if maybe you've done Roth conversions in the past, or you've set up your portfolio in a way that you don't have to start drawing income until they force you to, RMDs, and you get used to being in these lower tax brackets. Maybe you're in a 10% tax bracket and you're in a single-digit effective rate, right? People get used to paying those low amount of taxes, and then when we start looking at potentially doing Roth conversions to maybe try and limit those future years, and I have to, if I'm recommending like, hey, well, maybe we do convert at 12% or 15%, 22%, a lot of people don't want to do that, right? They're used to these lower rates. They're like, oh, I don't want to pay, more than I have to on these marginal tax brackets. But that's the thing, marginal is what it is. It's marginal. It just means your next dollar is being taxed at that next bracket. So for example, I hear people all the time saying that they don't want to get bumped into the next tax bracket because they think all of their income is being taxed at that higher rate. That is wrong. Don't be a silly goose. That's wrong. Okay? If you're looking at your income, the first, 10,000 or so, I don't have the brackets in front of me, but the first bracket there is about, 10 or 11,000. Okay? Only that first chunk is being taxed at 10%. And then I think the next bracket is about $70,000 worth of income. That next bracket is only being taxed at 12%. And then the next amount of income is being taxed at 22%, so on and so forth. So if you're currently in the 12% marginal tax bracket and we start doing conversions that possibly bump you into a 22% tax bracket, only those dollars that are falling into that 22% bracket are going to be taxed at 22%. So that advanced tax bracket management, I'm simply just talking about, people that are used to paying lower tax rates. It's hard to try and convince them to, hey, pay a little bit more in the current year or the next year in order to try and limit, future years. Which leads me into the 7th point here is straddling those marginal tax brackets. Okay, so marginal tax bracket straddling is when we are looking at future income years, we're able to do projections and see, okay, what years is your income potentially going to be lower to where we can possibly do some Roth conversions and convert at lower rates. So think about it like this. Let's say you retire at age, 62, but we don't plan on taking Social Security until 70. That's an 8-year time frame that you're not going to have that Social Security income coming in. So as long as we have money set aside to cover your expenses for those 8 years or whatever, maybe we do Roth conversions in those timeline years, in order to, hopefully limit when the RMDs do start coming out, or when Social Security starts and your income does start piling up, it will lower your eventual RMDs and distributions from those pre-tax accounts. And on to our uncharted territory for this episode. Taking it a little bit different with this uncharted territory, I usually will talk about different strategies that you might not have heard of when it comes to retirement planning. Today is a little bit different. This uncharted territory is, and I'm bringing this up because it kind of gets close to home. I've had people, clients and prospects, prospective clients, kind of shy away from doing Roth conversions and shy away from advisors that are recommending Roth conversions. Now listen, an advisor does not make any more money whether you decide to do a Roth conversion or not. In fact, most advisors are paid by an AUM fee. That stands for assets under management, right? So the more assets that the advisor is managing, it's usually like a fixed percentage of those assets that they're making. Think about it like this, the less they're managing, the less they're getting paid. So when you do a Roth conversion, you're converting from your pre-tax account to a Roth, you have to pay taxes on that. If you're withholding from the conversion itself, so let's, for example, just say you're doing a $50,000 conversion, we want to withhold 10% of that, which is $5,000. Only $45,000 is getting moved over into that Roth IRA because the other $5,000 got sent to the IRS. That would essentially mean that the advisor is managing less assets. So if anything, the advisor is actually making less for doing Roth conversions. Granted that you're paying the taxes from the investments. Now, some clients will pay those taxes from cash sitting on the sidelines. You can do it either way. But the whole idea here is this truly is a client-first strategy. Okay, it's more about long-term planning than it is looking short-term, which is what most CPAs are doing. They're looking short-term. They're looking in the rearview mirror. How can they make as much tax refund for you in the current year? Whereas tax planning advisors are looking beyond that. We're not only looking at what you did taxes last year, but we want to look and see how can we lower your overall tax bill over your lifetime, okay? So Roth conversions are not to be seen as a sales pitch. They are a strategy. The best advisors are going to recommend them. And I would just say that, don't shy away from advisors that are recommending Roth conversions because they're definitely not getting paid more because of that strategy. Now, the key takeaway that I want everybody to remember from this episode is that Roth conversions are not for everyone, but they are worth exploring. So the right strategy can reduce your taxes, it can increase your flexibility, and protect your retirement income from those increasing incomes, increasing taxes, right? I'm all for everybody paying their fair share of taxes, but let's not leave a tip for the government. Let's not leave them a tip to the IRS. So I'm going to encourage everybody to review your projected income. If you have a financial plan, forecast what the next 5 to 10 years of income is going to look like. Are there any lower years where you can potentially knock out some Roth conversions? Are there some higher years where you're like, oh man, I don't know if I want to pay higher taxes. Maybe you do Roth conversions now. Speak to an advisor if you're not already. See if they can work with you on the timing of conversions, how much you should be doing, and just making sure that it actually makes sense for your plan and not doing it just to convert. Again, that's letting the tax tail wag the dog. And then last, do not let fear or hype drive this decision, okay? Let the strategy lead. If it makes sense to do Roth conversions, or you are just a firm believer that tax rates are going to go up in the future, maybe do some Roth conversions. But if not, don't let anybody tell you that it is a make or break for your financial plan to do Roth conversions, okay? So thank you for everybody for joining us on the, wait, before you go, if you are within 5 years of retirement and you want to discuss if Roth conversions make sense for you, let's talk. There's a number and an email below. Give us a shout and we'd be happy to discuss with you whether this makes sense. So take out your pencils and write the number down that's at the bottom of the screen. As a reminder, everything that I talk about on this show is not to be taken as financial advice, legal advice, or tax advice, and all the opinions that I share are mine and mine alone, not for SWBC, the company. Please like this episode, comment if you want, tell me what you like about it, tell me what you don't like, tell me if you think my haircut that I got yesterday looks good.
Nope.
Or tell me if you like the idea of me using this gigantic pencil in future episodes, because I love it. Just some activity would be nice, so share it with your grandmother or your brother or whoever you want, and we'll see you next time on Uncharted Wealth. Peace! I know what that means.
Okay. Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.